So here are a few words that you'll quickly pick up if you're eager to learn in the stock market, if you're around constant day traders that are talking about day trading and about the stock market in general. Now, this is a very beginner friendly video, and I also recommend this to all my beginners that do want to get into trading or already started. I recommend this video. So let's jump right into it, guys, and let's stop yapping. Candlesticks is a block of data that holds information of price action. And the reason why this is the first term that I recommend you to learn is because no matter whether you pull up Forex, futures, crypto trading, a candlestick is always on your chart. That is the first thing that pops up, and it's defaulted on your chart no matter what. Candlesticks literally tell a story, and they tell you who is in control, and it's something that I recommend that all traders get into because it's super important to understand who is in control, whether it's buyers or sellers taking this candle. This is literally the foundation of how you can start learning about option trading and all the terms in your favor. Next is time frames, because you hear people like me saying there's a hammer candlestick on a 5-minute time frame or 15 minutes time frame, and all that means is the ability to view price action data, which is candlesticks, in different intervals of time. The higher the time frame, the stronger the move. So what I mean by that, guys, is this: if I'm looking at the 5 minutes, that means it takes 5 minutes for each candle or block of data to form. So at 6:35 a.m., this candle forms and creates this block of data. 5 minutes later, a new candle forms and creates this block of data. It's telling you a story because look at the wicks. But anyways, let's not get into that. That's for another video. 5 minutes later, another 5-minute block of data. But if I was to switch this time frame to look at the 15-minute time frame, this is what these 3 5-minute candles would look like on a 15-minute time frame. Because mind you that this is 3 5-minute candles, meaning that it takes 15 minutes of data to be created. And this is what it looks like on a 15-minute time frame. Now, if you understand candles and the story, you understand that this is a really strong candle. But again, that's for another video. And if you understand and want to learn more, I recommend you join the Discord. It tells you who is in control, which is the most important thing, and that sets the foundation. But let's continue on. The next thing you'll notice that's also on your chart, underneath your candlesticks, which is defaulted no matter what, is volume. Volume is always on your chart no matter what, unless you delete it, which I see a lot of traders do. Volume is located underneath the candlestick bars, represents the number of shares traded in each time frame. Let me say that last part one more time. Volume represents the number of shares traded in each time frame. So if I'm looking at the 5 minutes, that means there's going to be a certain amount of buyers and sellers selling within 5 minutes of this time frame. So you can see, just like the candlestick bar, every 5 minutes there's going to be a new volume bar for the 5 minutes volume bar. Same thing. It's just representing and showing you how much sellers and buyers were in that given time frame. That's how simple it is. Now I have a tool in my favor that breaks down how many sellers and buyers were in each given time frame. But look how you can use these tools in your favor, and you can spot the reversal here happening. And if you read candles and understand candlesticks, you can have spot or potentially enter the position here and gain some nice gain. Now, another term you'll hear is bulls or bullish, which is just a term used when you're leaning more towards an upward move on any given stock. You might hear a sentence like that. I might say the 5 minute looks bullish. It just means that on the 5 minute time frame, there's a bullish indicator or a reason that they're bullish. Bull market, which is just something like this on the bottom, which is when you see some higher highs and higher lows, which just means a nice structure to the bull market side. A bull market. That's what a bull market is. Higher highs, higher lows. We keep continuing on, and it's making more upwards movement. Now you can imagine bearish is just the opposite of bullish, and you might hear terms like the bears are taking over, which is something that I say a lot, and it just means that the sellers are stepping in. Or in other words, it means that the move is looking like we're going to the downside. Bear market is just the opposite of what you can imagine a bull market is, where the price is trending downwards, creating lower highs and lower lows because the stock is going down. It's decreasing in value, looking for a downward move. Contracts and contracts premiums. When you hear someone say contracts or contracts, that is option trading. That is what this is all about. They're typically looking at what contracts they're deciding to get into. All contracts have a premium to them. Premium is just a fee you pay for when getting into a contract. That's all it is. We all pay a fee to pay for a contract, and every contract has a different premium price to it. Now this is a little bit more in depth, but I'll also have a more in-depth video if you join the Discord, which gets more serious about all these things. But to go over the call size, calls is an option contract that you pay a premium for, which allows you to make money when the share price increases in value, thus increasing the value of your option contract. Basically, bets to the upside. You may hear things like looking for calls at a specific level, looking for calls at a support level, and all that means is that you're bullish, and the words bullish and calls both represent moves to the upside. So if you're looking for calls, you're basically bullish, and if you're bullish, well, you want to find yourself in a nice call position. Now to the right side, you have puts. Puts is also an option contract that you pay a premium for as well. It gains value in the opposite direction. It gains value when the share price decreases in value, because you can make money, yes, when the stock price actually goes down in price. So not only can you make money when the underlying stock that you're trading goes up in value, but you can also make money when that underlying stock decreases in value, and you can take bets to the downside. You may hear words like, I'm looking for puts, or I'm into puts on SPY, and both bearish and puts both represent you're looking for a move to the downside. Because if you're bearish, you're basically saying that we're creating some lower lows, lower highs, market's looking pretty weak, you're bearish. Puts just means you're looking looking to take an option contract, which you have to pay a premium for to get into that option contract, and the only way that option contract can gain value is if the underlying stock that you're trading decreases in value, because you're betting it that it's going to go down. Now, to quickly go over it and how to spot the premium price for which contract you're getting into, guys, let's breeze through this, because like I said, I have a video on this that's more in depth, but I at least want to give you guys some sauce for all my new members and for all the beginner traders. If you're looking for calls, it's going to tell you on your option tab calls. Now, the strike is what you believe the underlying stock is going to go to. Now, in this case, this stock was already trading in between 393 and 392. Let's just call it 392.50. It's in between those two levels, and I can either bet it's going to go to 393 or 394 or 395. Now, the only way to tell the difference between how much these will cost me if I wanted to get into one to make that type of bet is to the left side is the premium area, where you'll see you'll have a decimal, because this is the strike. The strike is where you want to choose how far you think it will go, and to the left of that is where you can see how much the premiums cost. Now, I'm not going to go over the bid or the ask, because like I said, that'll be more for an in-depth video, as well as I'm not going to go over the Greeks and how the Greeks affect your contracts, because again, that's more an in-depth and we'll spend a lot here, a lot longer than we need to. So real quick, to go over the premium and how to calculate your premium is you just need to multiply this number by 10, and that is how much you will pay for a premium. So right off the bat, this one that I have highlighted, if I wanted to bet that the stock was going to go from 392.50, because guys, like we mentioned, let's just say the stock was already at 392.50. I want to bet that this stock's going to go from 392.50 to 394, which is a $1.50 move. I have to pay a premium of $145. How and why do I already know off the bat that that's $145? Because there's two ways to easily calculate this. And one way is a very simple mathematical way, and the second way is a very easy way. But first, let's get into the very simple mathematical way that is calculated, because when you're buying an option contract, you're leveraging 100 shares. So you need to multiply this specific number times 100. So 1.45 times 100 is 145. So $145. Now, the second way to easily get over this is just erase the decimal. Imagine that decimal's gone. $145. That's it. Last example we can go over is, let's go over this next one. Let's say we wanted to bet that it's going to go to 395. That's our strike. How much is the premium going to cost? It says 1.00. The first mathematical way is I can multiply this by 100. 1.00 times 100 is $100. Very simple. Or I can just eliminate the decimal in my head. Already know it's just $100. Okay, I lied. Last example, because I feel like this one will be really helpful and it'll click for everybody in their head. Let's say we believe it's going to go to 396. Very simple. I can multiply this times 100, this number right here, 0.67 times 100, which again, it's very simply just $67. Now, how can I do that? Very simply is just eliminate the decimal. There's no number in this before the 67. Eliminate the decimal, and it's just 67. $67 is how much you'll pay for the option contract. Same thing when it comes over here for the puts, guys. To breeze to the puts, since you guys kind of already know about premiums. If I was to bet that the stock price is going to go down in price, I want to look for the right side, and it's called puts. I look at the strike area, and since we're theoretically at 392.50, if I want to bet to the downside, I have to look for the price to strike that is below. So I'm looking at 391. How much are these premiums? Again, mathematically wise, very simply, I can just put 92 times 100 because I'm leveraging 100 shares, and it's $92. Or I can eliminate the decimal, and since there's no number before the 92, it's simply just $92. $70, $54, $155, $120. On to the next. Support and resistance presents price points where the stock tends to stop falling or rising due to buying or selling pressure. Now, what does that mean? Let's go over the very first few sentences. Represents price points where the stock tends to stop falling or rising due to buying or selling pressure. How support acts. Guys, look at this. This is why I love trading support and finding support levels, because look at this. Hammers, pow. Come to this general area, don't necessarily touch it, so maybe you don't take anything here. Whatever. Boom. Long wicks to the downside, candles close above, create that support. Boom. Again, retest that level with a long wick. Boom. That's a nice support level, guys. That's what you want to see on your support. You want to see your support, which support represents the price point, tend to stop falling. It's a potential reversal at support, guys. There's a potential reversal every time I support. Resistance represents where the price tends to stop rising, which is just a potential reject at resistance, guys. Very simply, every time we head into this general area, the price stops to rise. Now you can create a price point here, because you know that every time we get here, it tends to reject. Reject again and reject again, guys. So again, like we just learned, now it's acting like support. Continue on. I hope you guys are still with me. We're almost finished, guys. We got 10 more slides to get through, but these are really important. Trend lines and trends is a visual representation of the direction and momentum of a stock price movement. Higher the time frame, the bigger the move. So there's a 4-hour chart, and you guys can see higher lows, higher highs, higher lows, and that's where the general price movement is moving in that general direction to the upside. Then you can see lower lows, lower highs, and that's where the price tends to start moving. Higher highs, higher lows, lower highs, higher lows, lower highs, lower highs. And again, guys, until we start breaking structure again, higher highs, higher lows. So that's very simple trend lines. It helps you find the direction and momentum into a stock price's movement. Very important stuff. Candlestick patterns. Probably one of my favorites, and I don't necessarily rely on this too much, but I do help it in my favor because if I'm already bearish or bullish and I notice that this pattern is forming, then it just helps me with my analysis and be more confident in the trade setup that I'm already in. So as you guys can see here, whether you want to call this a bullish flag or an ascending triangle, it gets broken to the upside. Then we have something right here called a rising wedge, and it gets broken down to the downside, just like the pattern charts. Many of these on Google, you can find them everywhere. One of my favorites is the head and shoulders because honestly, when it hits hard. And if you can catch it, you can catch it. Whether you're FOMOing or chasing it, to be honest, these ones tend to hit hard. Now guys, we're almost done. We're about 5 slides left, but this is really important, and it's called pre-market, open market, and after hours. Because many times you hear people say you need to do pre-market analysis or it's in the after hours. And also one thing that most people don't talk about is open market, which is the times that we can trade. So pre-market trading occurs before the official market even opens. And the open market is trading begins during regular market hours, which is when we can start trading our option contracts. After hours is buying and selling of stocks that happens outside of regular trading hours, which is what we cannot do. We don't have no power to trade on those times. Now I already labeled them out here for you guys real simply, but you guys can see in the gray general area in these zones is the area that we cannot trade, the gray boxes. Now the black zones, which doesn't have that many candles in them, is where we can trade and have our opportunity windows to trade. I'm gonna give you guys some time to digest, but you can see open market is where we can trade. Pre-market is before the open market, and after is when the market closes, and it's called after hours. So there's a lot of time to do technical analysis when the market closes, and a lot of time to do your technical analysis before the market even opens. And then when the market opens, that's when you take your trade setups. Because look at this one, guys. Imagine if you caught this inverse shooting star or just shooting star in general. In the pre-market, you did your analysis and you were confident enough to load on the call or load on the puts. One very important thing that a lot of us talk about is pre-market highs and lows, which is something that I use a lot. And a lot of traders, not even just myself, but a lot of traders talk about this so much. It's almost like a religion. Pre-market high is the highest point the pre-market hit. Pre-market low is the lowest point the pre-market hit. It's very simple, but I have right here charted out already all the pre-market highs, guys. This is the highest the pre-market hit, highest pre-market hit, highest pre-market hit, and it's very self-explanatory. Pre-market low is just the lowest the pre-market level hit, which is the same thing. Many times traders like to take calls, which I myself like to do it too. When we break pre-market high, I take calls when we break pre-market high. If we break pre-market low, I take puts. Now these are the last few slides, guys. Now this is something that I recommend the traders don't dabble into if you don't know the basics, which is indicators. And then there's just tools to find the best probable setup in your favor. And they're all of these little squiggly lines that people call color books, color crayons, RSI. There's a whole bunch of stuff on here, guys, but I'm gonna drop down what they really are. All of these things that you see on my chart are just helpful tools in your favor to find out the best setup in your favor. Now there's more of them, but as you can see, I already labeled them out, and I don't use all of these, guys. Literally, I just put them out here to show you guys. VWAP, which is volume weighted average price, is not even on here because if I had it on here, it would be so crowded. But it's another line that runs through the chart. EMAs is what I have running here, and I have it labeled out. And it's the blue, it's the yellow, it's the red line that you guys see running through here. Guys, these are just indicators, and you can see you can't rely on them because if you were to try to take calls on every time it came to test the EMAs, you would get wrecked on at least maybe the third one or the fourth one. There's simple moving averages, there's Bollinger Bands, and there's something that I have here called pivot points, which is the red and green levels. But even then, guys, it's supposed to reverse here. Look at that. If I would have relied on that, I would have got wrecked. So they're not always something to rely on. It's just a tool to help you in your favor if you already have something set up. Like maybe you could have took puts here because this inverse or this doji that's pretty weak. Maybe you could have tried to take puts here if you would have caught that right at that area. But then look what happened after this bearish engulfing. Doji right at the 9 EMA and you get wrecked. So guys, those are just indicators. And there's a whole bunch more. So if you guys find this video helpful in understanding the stock terms, understanding the lingo in the stock market, guys, there's a lot more to it. And you just need to be a part of the community that's talking about trading every single day. If you're not around a community that's talking about trading every single day, then what are you doing? It's so helpful to be around somebody that's talking about trading all the time. So with that being said, guys, please drop a like and subscribe and leave a comment if this video did help you guys. If you guys would like to join the Discord, I am doing half off. Just type in the discount vlogs at the checkout and hope to see you guys in the trade zone.